If you retire before 65, your employer health insurance disappears, and what replaces it could cost you anywhere from $200 a month to $2,000 a month, depending on one number most people overlook. By the end of this video, you'll know the three main options for covering that gap and the income trick that determines which one you can actually afford. So here's the short answer. Most early retirees cover health insurance before Medicare through the Affordable Care Act marketplace, the same exchange created under the Affordable Care Act. And the reason it works is that the ACA subsidies are based on your income, not your net worth. You could have $2 million in your IRA and still qualify for significant premium subsidies as long as your taxable income stays below the threshold. That threshold is the key. It's called the subsidy cliff, and it sits at 400% of the federal poverty level. For a married couple, that's roughly 400% per couple. Stay under it and the government helps pay your premiums. Go even $1 over and you could owe every penny of those subsidies back at tax time, which basically means your health insurance cost in early retirement isn't really a health insurance decision. It's an income planning decision. Let's walk through the three main options quickly. One option is COBRA.
When you leave your employer, federal law lets you continue that same group plan for up to 18 months. The catch? You pay the full premium, your share plus what your employer used to cover. For a couple, that can easily run $1,400 to $1,600 a month. COBRA is a decent short-term bridge. Say you retire in October and just need to get through the end of the year, but it's too expensive for most people to ride all the way to 65.
Option 2. The Affordable Care Act marketplace. This is where most early retirees land, and it's where the planning gets interesting. If you control your modified adjusted gross income, you can keep premiums genuinely low. We're talking a few $100s a month for solid coverage. But here's where people get tripped up. A Roth conversion you did in February, that counts as income. A capital gain from rebalancing your portfolio in March, income. An RMD from an inherited IRA, income. Every one of those can push you closer to or over the subsidy cliff, sometimes without you even realizing it until you file your taxes. Think of it like a pool with a maximum depth line. Every dollar of income is water. Roth conversions, capital gains, dividends, Social Security, they're all pouring in from different faucets. Go 1 inch over the line and you don't just lose a little subsidy, you lose all of it. Option 3. Healthcare sharing ministries or short-term medical plans. These exist, but they're not traditional insurance. They often exclude pre-existing conditions, have coverage caps, and aren't required to cover ACA essential benefits. For most early retirees with real assets to protect, they're a risky bet. So what actually matters here? It's the coordination. Your health insurance cost is connected to your Roth conversion strategy, which is connected to your capital gains planning, which is connected to when you claim Social Security. Pull one lever and it moves the others. That's the kind of thing that's hard to see when your investment advisor, your tax preparer, and your insurance agent are all on different pages. If you're approaching your early retirement, or if you're already in it and realizing your income decisions this year might have consequences you didn't expect, it's worth getting a second set of eyes on how all of these pieces connect. You can start at www.themadisonpartners.com.